Good afternoon, everyone. Thank you for signing up for today's exciting masterclass on managing the unexpected. That's some of the things that surprise us in our financial life that we may not be prepared for. I'm Kurt. I'm your presenter. This has been a very popular masterclass. We're excited to share our insights with you. I will run through a few logistics before we get into the presentation so you know what to expect and what will happen over the next 30 to 60 minutes. Slides are available upon request. I'll have my email address up on a few in just a moment. Again, I'm Kurt LaLomia. I'm a financial advisor at Turning Point Financial. Here's a little bit of background and bio on me. I specialize with federal employees. That's noted among my designations. I started my career on Wall Street. I spent much of it in legal and compliance. Compliance is the reason I moved to the advising side of the business. Many advisors I supervised, they weren't doing things the right way, and I wanted to make a difference. My firm, Turning Point, is a registered investment advisor. We're located in Frederick, Maryland. The SEC is our regulator. We're independent, we're female owned, we're a team of 25. We're fiduciaries. That means we're required by law to do what's in our client's best interest. We get asked that question every day. It's important. If you're looking for an advisor, make sure they're a fiduciary. One last thing, we work with clients across the country and from most of the federal agencies. Next is a look at our webinar schedule for this year. Many of the events from earlier in the year, they've been recorded. We make those slides and recordings available. Again, send me an email if you'd like to have any of that information. Here's what we're going to be talking about today, what we're diving into. And before I get into that, I'd just like to say this is educational. This is about financial literacy. This is not a sales pitch. I think I'll open your eyes to some things. I think you'll all learn something new. Your participation today, it entitles you to a complimentary meeting with me. If that's something you're interested in, I'll tell you how that works a little bit later on. So let's get after it. Stock market corrections, they're normal, they're healthy. You should expect them every 3 to 5 years. A correction occurs when the market is down 20% or more. Last year was painful for many, and most people I know, they lost money. There simply was nowhere to hide. The bond and stock markets were down simultaneously, which is not only unusual, it's rare. The last time that occurred, more than 100 years ago. Money typically flows from one market to the other based upon how people feel about risk. All the questions on this slide, they create stress. Unfortunately, they're a part of life. The best thing that you can do when markets are going through corrections is to be patient and to get some advice. If you don't do these things, then you may be making a mistake. An example of making a mistake, it might be panicking because you're frustrated with the declining value of your TSP or your 401k. This panic, it might cause you to move all your TSP investments to the G fund. And when you do something like that, you're likely locking in losses and you're missing out on future growth opportunities. Folks, it's time in the market that matters, and trying to time the market does not work. Let me say that again. It's time in the market, not timing the market. Timing the market is a fool's game. It's a fool's game because it requires you to be right twice, every time. So don't do that. Rather, stay the course. Stay invested through the tough times. Patience pays. That's what I recommend. Advice pays. That's what I recommend. These two things will save you a lot of money and make you a lot of money. How do I know? I've been in the business for over 30 years. I have the experience and wisdom to back up these statements. In fact, What I recommended to many of my clients last year when the markets were down was not only stay the course, but put more money to work if you're able. That's taking advantage of a market on sale. And over the course of a 20 or 30-year career, these market corrections, they're mere bumps in the road. If you're in and out and trading your TSP, you will make a mistake, and one of those will likely be very costly. I hope this makes sense, and if you need any help understanding more fully what I'm saying here today, let me know. We're going to move along. Next, we're going to dive into the 3 fundamental portfolio practices. We're going to talk about patience, more discipline, and how our opinions affect our behavior towards investing. Our behavior can sometimes get the best of us. It happens to all of us. It's happened to me. Oftentimes, we can be our own worst enemy, and this is where making emotional decisions can be dangerous and expensive. In the industry, this is what we call behavioral finance, and it's why everyone needs the guidance of a trusted advisor. Some folks can and do go it alone, the do-it-yourselfers, but that's rare. It's no different than hiring an attorney, a plumber, an electrician. They all have expertise, and we bring these people into our lives for a specific reason. Some of you are here because maybe you're looking for an advisor, and I've said to these venues many times, this is an excellent place to check us out. You want and need someone you can trust, someone you like, because what this becomes and what you want is a long-term relationship. You want someone that can solve whatever it is you're looking to accomplish. I've mentioned working with a fiduciary. I'm a fiduciary. My firm is a fiduciary. We're bound by law to do what's in your best interest. These are all things for you to consider and think about, because working with an advisor will help you to be patient and have discipline to execute a strategy that's appropriate for your family. An advisor will help you with the 3 fundamental portfolio practices. Just so you know, a good advisor also evaluates its prospects before taking them on as clients. For example, I spend a lot of time when meeting someone to determine if they're a good fit for my practice and my firm. We don't take on everyone. Like you, I want to work with someone I like. I want a long-term relationship. I want someone who values my advice, who will take it. These are all things for you to think about as you begin to take the next step towards possibly working with an advisor. I want to briefly get into the 3 fundamental portfolio practices. Asset allocation, that's how you're invested. That's unique to all of us. Some of us may be comfortable with risk, and we have 100% of our money allocated to the stock market. An example of this with the TSP would be having all your money invested in the CS&I funds. Another example for someone with a moderate risk tolerance would be having 50% of their money in the C fund and 50% of their money in the F fund. That's a 50-50 allocation. 50% stock market, 50% bond market. Diversification is how risk is managed. We want the right amount of diversification to lower our risk. The TSP has only 5 funds, so it can be a little tricky. If you own all 5, I would call that well diversified. This gives you exposure to large companies, small companies, international companies, the bond market, and cash. Problems can occur. Problems can occur if you're over-diversified or under-diversified. So you might want to check with someone to ensure you're getting this right. Rebalancing, that will help keep your asset allocation and your diversification where it belongs. We suggest doing that at least once a year. At Turning Point, we rebalance our client portfolios quarterly. That's a common frequency. TSP rebalances its L funds quarterly, happens automatically behind the scenes. An example of rebalancing with the L funds is they become more conservative as you age. For example, and this is only an example, not a recommendation, if you happen to own the L2040 fund, as you get closer to the year 2040, the TSP rebalances gradually. It's moving money from stocks to bonds with the idea that you're approaching retirement. You're less comfortable with risk. There's less of a need to continue to grow your money. So if you own an L fund, rebalancing is not something you have to worry about. If you're not in an L fund, then it's on you to handle regular rebalancing. Let me know if you need help better understanding these concepts. We can do that in Q&A. We can do that in a private meeting. Our next slide, it may shake you up a little bit. It may shake you up a little bit because these scenarios are all very unpleasant. I'm sorry, but that's why we're all here, to be better prepared for these types of unexpected events. Anticipating that any of these are a real possibility and being proactive with our budget, with our savings, with insurance, all those solutions should give us a sense of peace in these areas. If you have a handle on your finances and any sort of budget, that's an excellent start and will help you when you run into a problem. Setting up an emergency fund with 3 to 6 months of living expenses, that's a basic and fundamental exercise. It may take you some time to get to that level, and that's okay. The sole purpose of having an emergency fund is to help manage some of the items on this slide. If you don't have one, I would highly recommend that you give it some thought and begin to build one. We have and use a budgeting worksheet with our clients. I'm happy to share that with you if you like. Just send me an email. It's free. I want to talk about insurance. Today's newer insurance policies, they now include something called living benefits. Think of these as disability coverage or long-term care and coverage. You can use the death benefit while you're still alive. It's new, it's unique, it's included in the cost. We can't say enough about it. Vaguely, that doesn't have this. No group life insurance has living benefits. Only a few insurance companies offer that. Let's look at an example, and I want to use long-term care in the example because that seems to be on a lot of people's minds today. For example, if you were to own a $500,000 term life insurance policy with living benefits and you have a long-term care event, you can access its living benefits and receive up to 24% of the death benefit each year. That's nearly $125,000 a year. That's going to cover most assisted living facilities. And while we're on this topic, actually, before I get to that, if you didn't use that $500,000 life insurance policy for long-term care and the living benefits, there's a $500,000 death benefit, a tax-free death benefit. That's going to go a long way towards helping your family if something unexpected happens to you. My other thought, while we're on this, make sure you have a will, an estate plan. Most people don't. It's so fundamental. We all put it off. If you need an attorney, an estate attorney recommendation for your area, let me know. I can send you some names. Moving on. What we're really talking about here is risk management and how we all manage various types of risk that exists in our lives. Insurance is a tool to help us manage unexpected events. At Turning Point, we use something called the DIME principle. It helps us determine how much life insurance a family needs. DIME is an acronym. D stands for debts. You want to have all your debts paid if you die unexpectedly. I is income. We need to replace your income for some period of time. M is the mortgage. We want the mortgage paid off if we were to die unexpectedly. And E is education. We want to have the kids' education covered. Add all these up. That's a good starting point to understand if you have enough life insurance. Policies that we offer at Turning Point, they all come with living benefits. So that's a big plus. And the question at the bottom of this page, that's worth giving some thought to and contemplating what life would look like if all of a sudden you're not around. Do you have enough? And how much is enough? Enough life insurance to protect what matters most. If you don't, here's what can happen. We don't need to go through all these. Most are fairly obvious. These are ugly. I know it, you know it. None of us wants this to happen to our families. Unfortunately, this is reality. FEGLI, or the group life insurance offered by the federal government, that allows you to get up to 5 times your salary. That's nice, but it's likely not enough depending on your circumstances. You can supplement that with private insurance and have the living benefits too. Another thing I've mentioned in the past at prior webinars, maybe you've attended, the cost of FEGLI, it goes up as you age. Private insurance often costs less. If you're 50 or older and in good health, you should check, see what you're currently paying and shop around. We can get you some comparison quotes for free if you would like. I'm 58. I've worked at 7 different companies during my career. Some of these were really great companies, and when things are good, you never believe or even think about what trouble might lie ahead. We all face adversity at some point, and we can prepare for it. It's foolish to believe. It's foolish to believe that anyone would have a career of 20, 30, 40 or more years and that it would be smooth sailing the entire time. Taking care of some basic fundamentals during the good times will help you manage the not so good times. Make sure you have enough life insurance, preferably with the living benefits. Make sure you have a sufficient emergency fund. Make sure your debt doesn't get out of control and strive to become debt free. Having and living with a budget, that's going to help you in all of these areas. There are a lot of online budgeting tools that now exist. These are some of the ways to help you manage the unexpected financial circumstances that will occur at some point in your lifetime. One of my clients lost his job. He was 60. He had done all these things, and he was positioned to not have to work for a long time. He went to Europe. He had a good time. He casually looked for his next act and eventually found it. We all want that sort of freedom and flexibility when hard times hit. We all need an aging plan. An aging plan is all about thinking, planning, talking with your family about how you want to live out your final years. We all need to do that. We all need to do that because if we don't, then someone else will be making decisions for us, and we might not like those decisions. We spoke about the potential solution that now exists with living benefits and insurance policies. That's one idea. Medicaid is another solution. Some will rely on family. That's probably the most common form of an aging plan. Some folks will self-insure or at least attempt to. I say attempt to because you don't know how much it's going to cost, when it will occur, or for how long. Look, long-term care insurance is a supplement to what you already have going on. No one can insure for the whole thing. It's a supplement to your Social Security, to your pension, to your RMDs. Many of our clients, they have long-term care insurance as portfolio protection. They take some of their existing savings, they get long-term care insurance, so they don't have to sell assets at inopportune times, like last year. That can mean losses. That can mean higher taxes. Insurance is an asset. It should be a part of your overall portfolio, not just for the death benefit, but for the living benefits, for diversification, tax-free growth, and lots of other benefits. Long-term care insurance benefits, they're paid two different ways: cash or direct reimbursement to the provider. Cash is the better option. The type of policy you choose, it determines which payout option you get. Cash, it gives you flexibility versus having to submit receipts, coordinate with the insurance company, the providers, all of that. Three types of long-term care insurance policies exist: traditional, hybrid, and what we've been talking about, life insurance with living benefits. Traditional is the most expensive. There are a few options because many insurance companies have gotten out of the business. They've been burned. Traditional premiums increase by 10 or 15% each year because it's a challenge for insurance companies to manage. And it's use it or lose it. It's just like homeowner or auto insurance policies. Hybrid is another type of long-term care insurance. It's what I have. There's three features the hybrid offer. It's built for long-term care benefits. If I don't use those or only use a portion of those, there's a death benefit. My family gets paid. And if life changes at some point in the future, I can get my money back. There's a return of premium feature. That's the hybrid. Living benefits in a life insurance policy, it can be term insurance, it can be permanent insurance. My wife has this. This is the least expensive option. It's what we've been talking about. It's a policy that allows you to access the death benefit while you're still alive. With all of these, you have to qualify. On the slide, we've listed the 6 activities of daily living. When you can't perform 2 of those, you get your doctor's note, you give it to the insurance company, and they start providing benefits. I know I have a lot going on this slide. It's likely overwhelming. A conversation with your family about how you want to live out your final years, that's how it all starts. That's step 1. That's what I need everyone to do. All right, we're getting near the end, folks. I appreciate your patience. It's our view that Social Security will always be around. Everything you hear in the news, it's noise, it's nonsense, scare tactics, and saber rattling. No politician is willing to risk their future to vote for any sort of cuts. Rather, what you'll likely see are things that have occurred in the past. The retirement age will be raised. It was last moved from 65 to 67. The Social Security tax that we all pay every pay period, that can be raised. The income limit at which Social Security tax stops, that's raised every year, but that can certainly be adjusted. These are all easy fixes and options that the politicians will employ at some point to preserve Social Security. No one should expect a cut in their Social Security benefits, in my view. Now, with all that said, a problem exists, and I don't have the solution. People are living longer. The workforce is shrinking. Social Security is going to continue to be a hot button and a talking point during all of our lifetimes. As I said, I'm 58. I have no worries about not collecting my benefits. Medicare Part B premiums, we discussed those extensively in our last masterclass. Those are based on your income. The more you make, the larger your Medicare premium. Tables are available online. The premiums vary between $150 and $550 a month. Quite a range. Having tax-free income is the best way to manage this expense. Tax-free income can only be found in two places: the Roth and cash value life insurance. We recommend and use these strategies extensively with our clients. Taxes. We all know the current tax code, which is lower. It expires in 2.5 years. And then we revert to the older, higher tax code beginning in 2026. That is certain, unless something is done by our next president. This means we all have a short window to continue with our Roth contributions, our Roth conversions, taking advantage of today's tax rates on sale. Most people believe taxes will be higher in the future. They have to be. It's the only way to manage the country's debt. Here we're talking about managing the unexpected, and higher taxes should not be unexpected. Embrace this opportunity now. Plan for it, using the suggestions from today's class to prepare. Higher taxes mean a tighter budget, and you want to be ready for it. I'm sorry to be the bearer of bad news. This is reality. Folks, slides available upon request. Here are action items to managing the unexpected. Look over your budget. Make sure you have an emergency fund. Take a look at your asset allocation and your insurance. Go back to your agent and ask for a policy review, or let me know. I can help you evaluate your current insurance policies. We don't want to go it alone. Make sure we're working with a trusted advisor. Don't panic. Make an emotional decision. Think about your aging plan. Make sure you have an estate plan. And then tax planning opportunities. We just covered that. Folks, I'm a resource, and this is probably not your only advisor-hosted event that you've attended. Use us. There are a lot of us. We're in the business. As we wrap up, I want to thank everyone for your patience and for being here today. My full contact info is on the screen. Please reach out if I can be of any service. Consider me a resource, whether it's now or in the future. Early on, I mentioned a complimentary meeting. Your participation today entitles you to a complimentary meeting. Just send me an email and we'll get that scheduled. Another freebie my clients enjoy is a monthly piece that I put out called Weekend Reads. It's an eclectic collection of interesting articles, recipes, essays, travel topics, and books that I've discovered that I like to share. Our June edition is going out next week. Email me if you'd like to be added to Weekend Reads. It's free. Thank you again for being here today. I hope you'll consider attending events in the future. We try to do these each month. Have a wonderful summer. Be safe and stay healthy. Thank you.